On March 16, 2020, the stock market fell so fast that trading was automatically halted within minutes of the opening bell. The S&P 500 dropped 12% in a single day. Investors watched 3 years of gains vanish in just 33 days. And yet, the people who kept their heads during that chaos made some of the best returns of their lives. Welcome back to the Daily Investor, where we study the lessons that history teaches us about building real wealth. Today we are going deep into the COVID crash of March 2020, the fastest bear market ever recorded. We will break down exactly what happened, how fast it happened, why even legendary investors were caught off guard, and most importantly, what this 33-day nightmare can teach you about surviving the next crisis. Because there will be a next one. There always is. To understand just how violent the COVID crash was, you need to see the timeline. On February 19, 2020, the S&P 500 closed at an all-time high of 3,386. Unemployment was at 3.5%. Consumer confidence was strong. The economy, by almost every measure, was humming along. Nobody saw what was coming. Then the World Health Organization began raising alarms about a novel coronavirus spreading from Wuhan, China. By late February, cases were appearing in Italy, South Korea, and Iran. Markets started to wobble. And then they didn't just fall, they collapsed. It took only 16 trading days for the S&P 500 to fall 20% from its peak, officially entering bear market territory. That is the fastest descent into a bear market in recorded history. For comparison, the crash of 1929, the one that kicked off the Great Depression, took 42 trading days to reach that same threshold. By March 23, the S&P had bottomed at 2,237. That is a 33.9% decline in just 33 calendar days. Trillions of dollars in wealth, gone. And the human toll was staggering. In April 2020 alone, the U.S. economy shed 20.5 million jobs. Unemployment spiked to 14.7%, the highest reading since the Great Depression. Here is something that really captures how extreme this period was. The stock market has automatic circuit breakers, mechanisms that halt trading entirely when the market drops too fast. A level 1 circuit breaker triggers when the S&P 500 falls 7% in a single session. Before March 2020, the modern circuit breaker system, which was adopted in 2013, had never been triggered. Not once. In March 2020, it was triggered 4 times in less than 2 weeks. March 9, the S&P fell 7.6%. Trading halted. March 12, it fell 9.5%, the worst single day since Black Monday in 1987. March 16 was the most terrifying of all. The market dropped 12%. The VIX, Wall Street's fear gauge, spiked to 82.69 that day, surpassing even the peak of the 2008 financial crisis. And on top of all this, a price war between Saudi Arabia and Russia sent oil prices into freefall. On April 20, 2020, West Texas Intermediate crude oil futures went negative for the first time in history, settling at negative $37.63 per barrel. Sellers were literally paying buyers to take oil off their hands. The fear was not just financial. It was existential. Nobody knew how long the pandemic would last, how many people would die, or whether the economy could survive a global shutdown. This was genuine uncertainty, not the garden variety worry that comes with a normal correction. Now here is where the story gets remarkable. On March 23, the day the S&P hit its bottom of 2,237, 2 things happened that changed everything. First, the Federal Reserve announced unlimited quantitative easing. Not a specific number, not a cap. Unlimited. They would buy as many treasury bonds and mortgage-backed securities as needed to stabilize the financial system. 4 days later, Congress passed the CARES Act, a $2.2 trillion stimulus package that sent direct payments to Americans, expanded unemployment benefits, and provided forgivable loans to small businesses. The market turned on a dime. From the March 23 low, the S&P 500 recovered to its pre-crash high by August 18, 2020. That is a complete recovery in roughly 5 months. And by year-end 2020, the S&P closed at approximately 3,756, meaning the index finished the year up about 16% despite the worst crash in a generation. Think about what this means. If you had invested $10,000 at the market's peak on February 19, you would have watched it shrink to about $6,600 at the bottom. Terrifying. But if you held on and did absolutely nothing, you would have been back to even by August and up to about $11,100 by December. And if you had the courage to invest an additional $10,000 at the March 23 bottom, that second investment alone would have grown to approximately $16,800 by year-end. So who had the courage to act when everyone else was paralyzed by fear? Let me give you one of the most extraordinary trades in modern history. Hedge fund manager Bill Ackman saw the crisis coming in late February. He spent $27 million on credit default swaps, essentially insurance policies that would pay off if corporate bonds crashed. When the market imploded in March, those positions generated approximately $2.6 billion in profit. In roughly 3 weeks. But here is the part most people miss. Ackman did not just cash out and celebrate. He immediately reinvested the $2.6 billion into stocks like Hilton, Lowe's, and Berkshire Hathaway at their beaten-down prices. He used fear as fuel. Meanwhile, Warren Buffett took a more cautious approach. Berkshire Hathaway was sitting on roughly $137 billion in cash at the end of the first quarter of 2020. Critics expected him to go on a buying spree. Instead, he sold all of Berkshire's airline holdings, stakes in Delta, American, Southwest, and United Airlines, locking in losses. He later acknowledged the sale at the May 2020 annual meeting, saying the airline business had fundamentally changed. But Buffett was not sitting idle forever. By the end of 2020, Berkshire had acquired significant new positions, and Buffett authorized billions in Berkshire stock buybacks at prices he considered attractive. His lesson was not about catching the exact bottom. It was about waiting until you understood what you were buying. As Howard Marks of Oaktree Capital wrote in a memo during the depths of the crash, the riskiest thing in the world is the belief that there is no risk. March 2020 was a brutal reminder that risk never disappears. It only hides for a while. Here is the one principle I want you to carry away from today's video. The COVID crash proved something that value investors have known for over a century. Markets can do anything in the short term. They can crash 34% in a month. They can trigger circuit breakers 4 times in 2 weeks. They can send oil prices below zero. But over the long term, the market rewards the patient and punishes the panicked. The investors who sold at the bottom in March 2020 locked in devastating losses. The investors who held firm, or better yet, bought more, were rewarded within months. You cannot control what the market does. You can only control how you respond. And that response is what separates investors who build wealth from those who destroy it. This is educational content, not financial advice. Past performance does not guarantee future results. Always do your own research. If this breakdown helped you understand what really happened during the COVID crash, hit that subscribe button. We study market history every Friday on this channel because the best way to prepare for the next crisis is to understand the last one. Drop a comment below and tell me, were you invested during March 2020? What did you do? Did you hold, sell, or buy more? I would love to hear your story. Tomorrow, we are breaking down how to actually read a balance sheet, step by step. You will not want to miss it.